The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to another MLA Productivity and Profitability webinar. My name is Peter Haviland. I work for the webinar coordinators Aggregate Consulting, and tonight we'll be presenting a webinar on cattle markets analysis, and we're specifically going to look at PTIC versus slaughter values. We're lucky to have Matt Dalgleish from Thomas Elder's Markets to deliver this content for us tonight. Before I hand over or introduce and hand over to Matt, I'll just quickly step through the basics of how to navigate using GoToWebinar. So essentially, all you need to focus on tonight, guys, is the orange arrow to minimize that, so you'll be able to see Matt's screen fully. You'll see basically the only other aspect you need to focus on is if you want to ask us a question. So I'll monitor these throughout the webinar. Feel free to send me through any technical queries if you're having audio or video issues. And if you've got any questions for Matt, send them in as they pop into your head. We'll cover them off at the end of the webinar. Finally, we really value your feedback. MLA really wants to hear from you about this series, so please complete the survey before exiting, and I'll remind you when we get to questions on that one. So a little bit on our presenter, Matt. Matt's had a little bit of a varied background, but definitely economics focused, as well as a little short stint in education. Actually started trading Forex markets while he was still in school, and then after his degree, he transitioned across to work for one of the big banks for about a decade. After a short stint in education, he's actually moved into the agricultural sector, which you'll all be probably familiar with his commentary now with Thomas Elders. So Matt's great at using his data skills, providing commentary, and actually distilling some quite complex concepts into simple messages. And of course, he focuses on the livestock sector as part of the Thomas Elders team. So that's a nice short intro from Matt. That's enough from me. I'm going to hand over to Matt, and he can step you through what he's got to present tonight. Matt, you should be able to take control now.
Yep, I've got that now. Thanks, Peter. While I'm just getting set up with this slideshow, I'll just take the opportunity to thank both Aggregate Consulting and MLA for putting on such a great series of webinars. I haven't been able to catch all of them, but some great information that's being portrayed, and hopefully I can match the standard that's already been set with my presentation tonight. I presume, hoping you can all see that. Peter would have told me by now if you can't see my screen, I'm sure, so I'm just going to forge ahead.
Yeah, looks good, sounds great, mate.
Excellent. So I'll just spend a couple of seconds just outlining who we are, Thomas Elder Markets, if you haven't heard of this before. We do provide economic and market analysis-based advice on agricultural markets. We focus on the Australian market, of course, but we also do look at the market globally that has an impact on Australian agriculture. We have an independence charter. We are part of the Elders Group, but we are quite independent of Elders ourselves, and we have an independence charter that makes sure that the information, the advice, anything that we give on the website is absolutely independent and without any kind of strings attached or any direction to talk a certain narrative. So we just talk about what the data is showing us and what we think that means for producers or for market participants. We cover off, like I said, on all major commodities which impact the rural sector, from grains and oilseeds to inputs to fertiliser to fuel to livestock to fibres. If you have an interest in it, it's pretty much on the website. And that leads me to just give a quick plug for the website. It's thomaseldermarkets.com.au. It's an absolutely free service. You can jump on and subscribe to the regular, very short analysis pieces that we put out on the market that come through pretty regularly, and you can just stick an email address in the sign up page and tick off what particular commodities you're interested in, and as we do articles on those commodities, you'll get an email telling you it's there so you don't miss anything. Absolutely no strings attached. Sometimes when we present, people always don't believe that is actually true, but we do charge for services for clients that want us to do more bespoke, tailored packages that can include, market intelligence reports or state of the injury reports, or some benchmarking that's different to what the team at Aggregate do. And so, we work for consumers of agricultural products, producers of agricultural products. We do work for investment funds, both direct and offshore. We work for some of the big corporate farms, whole range of clients that we work for that actually pay us for the work. But what's provided on the Thomas Elder Market website is a bit of a snapshot of the types of things we do that's quite generic, and it's a good opportunity if people want to keep informed of agricultural markets to jump on and subscribe, and you won't be bothered. I'll promise that you won't be bothered for buying anything, or we won't use your email address in the wrong manner. It's really just to let you know what we're doing on the website. So feel free to jump onto that if you aren't already on it. So this evening, I'm going to cover off just initially on some stats around what's happening with the herd rebuild and restocker behaviour. We'll move on to have a quick look at processor margins, and in particular margin model that we've developed at Thomas Elder Markets to look and see what's happening in the beef processing sector. We'll take a quick glimpse at offshore beef demand, some of our key markets and also some of our competitors, and see what's happening there from the demand side. I'll run through a couple of what I call fair value models for a few categories, just to give you an idea of what we're thinking in terms of this year for average annual pricing and what the model's saying for future years. And then we'll move into the PTIC spreads and prices, and there's quite a bit of that at the back end, so I won't dwell too much on the preliminary stuff, but we'll move into those PTIC prices and spreads. It'll be quite a chart heavy webinar, so not too much to read. Just listen to my dulcet tones and have a look at the charts and kind of ponder what I'm trying to put across. And then there will be time, as Peter said, at the end for question and answer. So we'll dive in straight away and have a look at herd rebuild and restocker behaviour. One of the ratios we look at quite often when the data comes out is the female slaughter ratio, which is effectively, it's a calculation or a percentage of the proportion of female cattle slaughtered in the country as a ratio of total slaughter. And it's quite a good indicator that gives us an idea as to exactly whether we're in a herd rebuild or in a herd liquidation phase, and how strong that phase is underway. So the first chart on the left-hand side just shows the annual average ratio in blue line, and then the orange bars are what the herd has done, whether it's grown or whether it's declined over that year. And you can see pretty much the threshold between whether the herd is in liquidation is if it's above 47%, the female slaughter ratio, and if the herd is in rebuild, like we are now, then that ratio is below 47%. And so as of the end of 2021, the annual average was 45.3%. So we're in what's called, I guess, reasonable rebuild territory, and we're certainly seeing that at the sale yard. That kind of incentive to rebuild is present. The interesting thing with the female slaughter ratio, and the chart on the right highlights this, when we look at data going back to the 1970s, and we calculate the many times it's been below 47% and how far below, we get a bit of a glimpse as to what you could consider as the average amount of time, or average amount of size of herd rebuild you see when it's below 47%. So the further away or the lower it goes below 47%, down to those low 40s, we tend to see stronger rebuilds. And conversely, when you look to the other side, when the female slaughter ratio is above 47%, the further and further it gets above 47%, we tend to see much higher liquidation phases. One of those most recently was the 2019 period, where we got an FSR above 53% for the year, and actually got to nearly 56 from memory, 56% as an annual average. You can see that on the left-hand side chart just there. and that year we saw in excess of a 6% decline to the herd. So it is a good indicator of what's happening on the ground with the cattle herd in Australia. One of the problems with the female slaughter ratio, it used to be the data was published monthly by ABS, but through COVID, they actually started reducing that service, and they now only publish the slaughter data that we create the female slaughter ratio from on a quarterly basis. And that means that currently we haven't got any data for the current season yet. The first lot of data will be published in May, and it'll be looking back at the first quarter from just January to March. So because we don't have something to see what's happening right now, what we did at Thomas Alder Marcus was developed a proxy for it, or a model, FSR, and that model uses what's happening in the sale yard in terms of restocker behaviour. So the spreads restockers are paying above other types of buyers, and also the spreads that breeding cattle are getting. So that's part of what we're looking at later in this this webinar on PTIC cattle and heifers. So that the combination of what the restockers are doing, how active and how aggressive they are at chasing livestock, and the combination of that and how much the premiums being paid for breeding cattle can give us a bit of an indication as to what's happening, how strong the rebuild or the destocking phases are, and we can use that information to create a proxy FSR. And so the orange line is the proxy based off what's happening at the sale yard presently, and we can see that for the first quarter of 2022 that FSR has moved down to below 41%, so in that really strong rebuild territory now, if you remember back to that long-term historic data. One thing so I'm kind of anticipating that the female slaughter ratio for the first quarter of 2022 is going to come in the low 40s, or certainly that 41-40% area. Sometimes, as the model shows, there can be a 3 to 6 month lag before what's happening with regards to the sale yard behaviour before it actually flows through to the data. So it may be this quarter, or it might be middle of the year before we see the female slaughter ratio down at that low 41% level. But it certainly indicates presently that we're seeing really strong rebuild activity in the Australian cattle herd. All right, we'll move across to processor margins. What I've got on the screen now is a combination of the AMPC processor model that was developed back at the end of start of 2019. I think it was published on a report, and AMPC developed a processor model that was a representative beef processor margin in terms of dollar per head being achieved by a beef processor, so single species processor. And at Thomas Alder Marcus, we're able to use, or we actually helped them build that original model. And so we kind of know how it was built. And when we set up Thomas Alder Markets nearly 2 years ago, we recreated a similar type model, not exactly the same, but a similar type model to what AMPC had created to look at processor margins. One thing I'll say is whenever we put this one out there, we always get a bit of querying around the figure, and you just got to remember that it's a representative model of a single species beef processor. It doesn't represent the whole industry. It certainly doesn't represent multi-species abattoirs. So just because this model is saying that there's significant losses doesn't mean, at presently, doesn't mean that every single processor is experiencing exactly this, and it's certainly not a representation of the whole industry. What's important is to look at the trend, not so much as the absolute value. And we can see by that long-term trend, this is a monthly average processor margin, we can see for a significant period of time, according to this model, they've been going through very tough trading conditions. And if you look, back historically, you can see that there is some volatility in this particular model. But yeah, that trend is we're currently in the worst, I guess, we've seen in 20 years of the collection of this data. So quite tough times for processors. If we have a look at the model on a seasonal basis, we can see it's been updated to February as of this year. So that chart on the left, just to give you a bit of a description, you've got the grey zone is what's considered a normal range in the margin based on the historic variability. So one standard deviation either side of the average, and the average, the long-term average is the dotted line. So you can see last year and this year have been very much below what would be considered normal for processor margins. We have seen a slight increase, a smaller loss from January to February. The January figure came in at $345 per head loss per animal processed for that model, and February's increased to $272. So it brings the average price so far for 2022 to $308 a head loss. The right-hand side chart shows you the annual average margin according to the model versus the annual Australian cattle slaughter level. So that lines across the bottom the million head of slaughter as reported by MLA. And you can just see that when we go through periods of very high slaughter and dry conditions and prices are pushed down because of that added weight of cattle coming through, processors are able to make quite strong profits, you know, when slaughter gets above, say, 9 million head per annum. And when we go through periods of really tight supply, like we saw last year when slaughter was down at 6 million head, is when the processors experience much more difficult trading conditions. One thing to note is MLA are forecasting now a annual slaughter for 2022 of 6.65 million head as per their most recent beef market outlook. And so that suggests that we should see this processor margin model start to move towards that $100 to $200 loss range over the next few months is what the model predicts should be the case given the increased slaughter. But we've still got a fair way to go before they get back into a level of profitability. So switch across to beef demand from our key export markets. So we've just got the top 4 markets that we send our beef product to. And an interesting note for March, the flows for March have pushed China back into second spot. So just pipped Korea marginally. So we have now Japan as our top market and has been for the last 3 years. They're taking around 26% of our beef exports. China's at around 19% presently so far in 2022. South Korea sitting at 18, or it's about 18.5% to be precise. And the US have dropped away to only 15%. And I'll go through a bit more on the US at the end of this because there's some reasons why the US are as low as they are now. So if we just zero in on what's happening in China and South Korea, we can see that the trend for China hasn't been too bad. If you go back to that seasonal chart where you've got the average line and the range, we're still within what's considered a normal range. We're pretty similar levels to what we saw last season. Not as strong as it's been in 2019 and 2018 when there was a lot of demand for our beef product because of the void in protein from African swine fever. But all things considered in terms of, you know, the many beef abattoirs that still are not having access back into China and the trade tensions that are going on, the very high prices we're seeing domestically flowing through to quite high relative prices compared to our competitors overseas, the Chinese market's held up relatively well. They're running currently about 15% below that average trend. So not too bad, all things considered. South Korea is also not too bad. It's actually been one of the stronger markets in the last few years. It's risen from being our 4th highest destination, and up until just this month, our 2nd highest destination. It's now dropped back marginally to 3rd top destination, but so far this season, beef flows to South Korea from Australia are running about 7.5% below trend. So quite strong considering, which is pretty good. If we move to Japan and USA, so Japan are running at levels quite weak. They're outside that normal range, that grey shaded zone. And so far this season, you know, been mostly lower than what we saw in 2021 as well. So far in 2022, Japan are about 30% below that trend. So quite a bit below the trend, which is a bit of a concern. Again, there are reasons for that, and part of that's some of the competition we're seeing from the likes of the US into Japan, which I'll go to in a minute. On the beef export side of Australian beef exports to the USA, we're seeing some really soft levels there. Currently, so far this season, the US are running about 44% below what would be their normal average demand for Australian beef exports going to the US. So that has been quite a significantly softer market both this year and last. And what it means for total exports, if we combine those top 4 plus all of the other destinations included, we're looking at the trend so far in 2022 is running about 25% below the average. So, again, reflective of the tight supply, the lower production, obviously, but also those higher prices that we're higher relative prices for Australian cattle compared to our competitors means that it is impacting some of our ability to get product into these offshore markets. I'll just do a quick deviation and just talk about the USA there. I mentioned how the USA are quite a lot below current levels, 44% below current levels for their demand for Australian beef, but the US are quite a peculiar situation when it comes to beef exports, because they are a customer of Australia, obviously, I've just shown you that, but they're also a significant competitor into our main markets. And if you see this chart on the left-hand side shows the market share for US beef exports. So where does the US beef go to mostly in terms of the top 5 participants? And we can see that the markets that are very dear to us, like Japan and South Korea and China, are also the markets that are key for US beef exports. And one thing to take out of that chart is particularly the line for China. If you look back pre-2020, it was almost non-existent, that beef market into China. But we had something called the Phase 1 trade deal that the Trump administration was able to negotiate for 2020 and 2021, and that saw China increase significantly their intake of US beef exports, so that by 2021 they were sitting at 16%, and in 2022 so far they're still taking big amounts of US beef. They're sitting at about 17% of US beef exports in terms of market share. That Phase 1 trade deal has now actually ended as of the end of 2021, but so far we're still seeing some really strong demand for the Chinese for US beef. So the concern there is hopefully that they haven't really fell in love with US beef, and the US are going to continue to be a strong competitor into a market that's quite important to us, and we really need to look to try and regain our ground in that market as the months and years progress. Another thing to look at is, like I said before, US is a beef customer of Australia as well. So we also look to see where else are the US getting their beef imports. And in that side of the market, we've seen a significant increase in terms of Brazilian exports of beef into the US. So the chart on the right-hand side shows the proportion of where the beef's coming into the US from. And over the last, say, 6 years or so, about 40 to 45% of imports of beef into the US had come from either Australia, New Zealand, or Brazil. But if you look at 2017, Brazil was only about 5% of that trade. As of 2022, they've increased to 25% of that trade. So there's been a significant increase of Brazilian beef into the US, and at the expense of both Australia and the Kiwis. So Australia, over that time frame, was around 23% into the US, and it's now down to 10% of the flows coming into the US as of so far this year. So we're getting a little bit pressured both from the US in China and from Brazil into our product into the US. So something to keep an eye on, because those kind of markets are important markets to us. And I'd probably just give an initial plug to the work MLA do in market, and a lot of our trade destinations. They do a great job at promoting Australian product, but also providing information as to what's happening in market. So they've done a great job at making sure our markets are very diverse, and we should really acknowledge what they do and be thankful of the incredibly hard work they put into helping the Australian producer push this product. Because with a population of just 25 million, we need to have a lot of markets for what we're producing to make sure we get the best prices we can. Speaking of prices, I'll just quickly have a drink of water while you divulge and have a look at the fair value modelling for heavy steer and EYCI. So these models are basically they're an equation that looks at key factors that influence the prices historically for both of these categories of cattle, and then kind of projects forward based on what the expectations are for things like slaughter, for things like the level of the Aussie dollar, for things like rainfall, what's projected in terms of whether it's going to be a good season or a poor season. It looks at the supply and demand factors, and then you plug in the variables, and it spits out a number that says, based on all these variables, the annual average price for the national heavy steer or the EYCI should be X. So looking at the left-hand one, we're seeing that there's a range that the model allows in terms of what the range could be likely to be as the fair value range for that year. And for 2022, the average annual price is expected to be 365 cents a kilo live weight, according to the model, with a range of about 330 cents to 400 cents. Currently, we're sitting at about 460 cents nationally for heavy steer on a live weight price. So the current prices for heavy steer are about 70% above the top of that range, so a bit overvalued. If we switch to the EYCI, the model has got an annual average forecast of 828 cents a kilo carcass weight for the 2022 season, and a potential range this year of 640 cents to 1020 cents. On the EYCI, obviously we're above that as well. I think we just closed at around 1090 the other day for the EYCI on a carcass weight basis. So based on that, the EYCI is around 7% above the top of that range. So both categories overvalued, and you can see projections as we move forward with increased herd size, increased slaughter as the years and increased production as the years progress to 2022, 2023. The forecast is for the market to soften. I wouldn't call them a crash, but certainly there are more headwinds on cattle prices where they sit currently than kind of strong demand pushing the market significantly higher. So the forecast or the fair value is saying over the next few years we should see pricing decline back by 2023, so back into that kind of low 300s area for the heavy steer and back towards the kind of 700-ish cent area into 2023 for the EYCI. All right, PTIC pricing. So I'll give actually another plug to MLA. Another service that they offer, if you're not already familiar with it, is the MLA interactive tool on the MLA website. It is a fabulous ability to get quite specific information on a whole range of animals, animal types, and types that are very relevant to your area. So you can filter for sale yards that are most closest to you and are most relevant to you in terms of prices. And this pricing data is available to download and then manipulate as you see fit. So if you're not already familiar with the MLA interactive tool, make yourself familiar with it, because there's a swag of information on there that you can, if you're so inclined, you can you pull it down and manipulate it to see what's happening in your area. Or if you're not as confident in doing this kind of stuff, get in touch with the team at Thomas Allen Markets, and we might be able to help you with that if you or at least do an article on something that's of interest to you. So don't be scared to drop us a line. These particular prices I've sourced, average prices, I've picked up 3 main sale yards on the East Coast, and the reason why I've chosen these 3 sale yards is because the pricing data was the best in terms of the amount of data there. There was quite a lot of data. Some sale yards, depending upon what's being presented, doesn't have as regular reporting for some categories. So I've just picked an average between Bairnsdale in Victoria, Carcoar and Dubbo in New South Wales for these prices of the relevant types. So this initial chart is comparing pricing for heavy steers in those 3 yards as a monthly average, heavy cow, and then also the heavier PTIC cow of 550 kilos and above live weight. So you can see how those have all kind of trended in terms of price. And then on the right-hand side chart, I've just picked out a measure, and this particular one is a percentage spread. I'll go into why I like to use percentages on the next slide, but that's just showing what's been happening over the last 3 years or so in terms of the spread of PTIC cow, that's 550 plus, to the PTIC steer. So you can see through that middle part of 2020, we got to levels where the premium spread was up around 15%, and that chart shows a similar thing, that the dotted line is the average for that period, and the grey area is what's considered the normal kind of range that it's fluctuated in for that period. So we got through a period there where they were quite, I guess, getting into more overvalued territory. But as you can see, this is as at the end of March, because it's monthly data. So all of these charts I show you now are monthly up to the end of March. We've seen that the PTIC cows actually softened back down just slightly below the average in terms of spread. And within that kind of range you consider normal. So reasonably, compared to steers, reasonably good buying at present for PTIC cows across those markets. If I just look at a longer term chart now, where the orange line on the left hand side chart is the same spread that I just showed you then for PTIC cows. But what I've done there is also overlaid the blue line, which is same kind of PTIC cow, but matched up to the heavy steer. That's the national heavy steer price. So I'm comparing one just within the one or the 3 sale yards to the same type of animal to the whole of the national market. So you see the spreads are not exactly the same because you're comparing 2 different prices, but generally speaking, they're fairly close. And you can see a bit more back history of the way that spread's behaved. So you can see in times, say back in 2010, 2011, we saw the last kind of decent rainfall event for 2-year La Nina. We got PTIC cows moving to a premium to steer, and again through that period into 2019. Oh, that was actually here where we saw, sorry, the 2019 drought. You can see it going to a significant discount. The 2016-17 rebuild, we saw it move to a premium again. Now, with that longer-term chart, like I said in the previous slide, the PTIC cow was running at about a 2% discount to the heavy steer as an average. But when you look back over the longer-term picture, that discount widens out to about a 15% discount as the normal kind of level that PTIC cow of that weight is to heavy steer. On the right-hand side chart, I've actually got the same spread, but expressed in a $1 per head measure. And I know a lot of producers like the $1 per head because it's easier than figuring out the percentage. That 15% discount equates to about $150 a head discount as an average. The reason why, though, we use percentage when we're looking at spreads, particularly when we're looking at spreads across many years, is that when you're taking just a $1 per head or a cents per kilo figure, it gets a little bit, I guess, impacted when you've got periods where prices for the actual animal have increased as much as we've seen over the last number of years. So for argument's sake, if you go back to, on this right-hand side chart, back to say 2005, 2006, we saw the discount go to $400 a head. So PTIC cows $400 a head below the heavy steer. But that's based off animals, say, that were worth, $1,500. Now, we're looking at, say, in January, when we had the last kind of drought, we saw that discount widen out to $600 a head, but that was on animals that, potentially worth, $2,500 or $2,000. So, when you're looking at it on a $1 per head basis or a cents per kilo basis, you're not taking into account how much the underlying price of the animal has moved as well. And if you contrast the right-hand side chart to the left-hand side chart, we can see that percentage terms, the spread through those drought periods of about 40% discount. And so it gives you a better indication as to what's normal, whereas what looks like on the right-hand side chart that the market's becoming more volatile and the spreads are moving to bigger and bigger levels, well, they are notionally, but they're not, when you compare them on a percentage basis, there is a much more accurate measure of what's happening underlying to the market. So the next whole lot of slides I'll be presenting will be all in percent levels because that's the more accurate way. If you do prefer the cents per kilo or the dollars per head, by all means, drop me an email and I can produce the charts in a $1 per head basis if that's your preference. So moving to a lighter weight PTIC cow and including now heifers as well in the pricing mix. What we've got on the right-hand side is the spread of PTIC heifers that are weighing between 350 to 550 kilo compared to the kind of cow, not the PTIC cow. So a similar type weight cow. And you can see that the average is about 35% premium that those PTIC heifers hold above the cow normally in terms of the last 3 years, with a range of about 5% to 65% premium. And you can see that currently, as of the end of March, those heifers of that weight range compared to the cow were above that normal grey zone. So that's indicating being slightly overvalued when compared to cow. And so that these spreads are a good way to look at when you're looking historically to see, am I buying into a market that is overvalued or undervalued compared to another category. And so for PTIC heifers, a little bit overvalued as of the end of March. Looking again at a longer term pattern, and you can see again the left-hand side is the orange one's the line we just saw a moment ago, PTIC heifers to that cow. And what I've got as well, the blue line is that longer term trend, again comparing PTIC heifer of the same weight to the medium cow, which is the national indicator. And again, you can see both of those spreads behave in fairly similar fashions, not identical, but similar enough fashions. And that long-term PTIC heifer chart actually shows that the longer-term historic average is about 15% premium rather than 35%, with a range of about a 20% discount during those drier times to potentially a 60% premium in the thick of restocker activities, which we saw not that long ago. We saw pricing up around that 60 to 80% premium for these heifers, so very high pricing for those types of heifers relative to cow. The left-hand side chart shows that PTIC heifer compared to a PTIC cow. And again, looking at the average line, we're talking about an average spread for PTIC heifer to cow is about a 15% premium, the average, with a range of about a 20% discount to a 60%. I just lost my spot there. Where are we? No, so it's like about a 10% premium for the PTIC heifer to the PTIC cow, with a range of about a 10% discount to a 30% premium is relatively normal. But currently, the PTIC heifer to cow is sitting at around 45% premium, as at the end of March again for those monthly averages. So that demonstrates that again, those PTIC heifers compared to PTIC cows are still quite overvalued. So if you're looking at something like that as a purchase, you're probably better to do the numbers for your region, of course, but maybe consider the cow rather than the heifer, because there's still quite a bit of strong demand for the heifers at these present times. So looking at that PTIC cow spread, so the heavyweight cow to the standard medium cow, we see again similar type measures for the current or the shorter term window. A similar type premiums being achieved when we go to the longer term trend. And for the long term trend for these PTIC cows to medium cows, about a 40% premium is what's considered relatively average over the period, with a range in the premium of about a flat to 80%. And currently we're kind of up towards that kind of mid to higher end of the range, so, or at least for the blue line. So not quite yet back at average levels, but we're looking like we're starting to head back to there. And certainly the pricing information for those 3 yards of Bairnsdale, Dubbo and Carcoar are already heading back to that average of about 40% as of the end of March. The last batch of PTIC comparisons of spread I'm showing are looking at cow-calf and cow-calf with calves at foot between 4 to 6 months, I believe this data is for. So not the younger calves, but the 4 to 6 month calves at foot. And looking at cow weights, lighter weight cows of 400 to 520 compared to the PTIC cow of 400 to 550. So comparing similar cows with the calf, similar weights to the equivalent PTIC cow. And then the right-hand side's looking at those heavier weight types. And so if we focus just on the lighter cow to calf to PTIC cow, the average spread we've been seeing in the last 3 years or so has been about a 40% premium, with a range of about 15 to 65% premium. And as the line shows now, we're pretty much sitting right at the average. So from say a recent history's perspective of the last 3 years, those lighter weight PTIC cow calves are reasonably good value compared to PTIC cows that haven't yet given birth. But if you contrast that to the heavier types, you can see that the spreads aren't as high in terms of premium spreads. So the average that the heavier cow calf are achieving above PTIC cows are around a 20% premium spread with a range of about kind of flat to 45% premium. And you can see that the heavier cow calves are still kind of at the upper end of that kind of normal range. So comparing those two types, if you're thinking of something along those lines, at least as of at the end of March, you should have been maybe considering the lighter weight cow calf rather than the heavier weight, just based on those kind of behaviours of spread. That pretty much ends the webinar in terms of all those spreads and prices. I believe it's being recorded. I know there's probably a lot of information to absorb in that, but I wanted to leave at least 15 minutes or so for questions, which we're coming up to that. One thing I'd stress just on those charts I've shown you, that they may not, those spreads might not be exactly the same that you're achieving at your local market. So like I said, if you're not already familiar with the MLA interactive tool, I'd highly recommend that you make yourself familiar with it, because you can actually obtain relevant pricing and spread information for categories that you are interested in, that are in your local area. And just becoming familiar with that tool allows you to be able to pull the data down and play around with it, and it just makes you a bit more informed in terms of what you're considering to do when it comes to your purchasing or selling decisions regarding the types of livestock you're running. So I think that's probably enough of listening to me rabbit on about the interactive tool, but it is fantastic. I'll just finish off in rabbiting on about Thomas Elder Markets. That's the website there. Like I said, if you are interested in all things agriculture and you want some good quality data-based free information with no strings attached, jump on the website and sign up. If you're on social media, Thomas Elder Markets have a Twitter account at TE Markets, which regularly posts tweets throughout the day and night about markets and what's happening in them. Also, my colleague Andrew Whitelaw, he has his own private account. He focuses in on inputs and fuels and fertilizer and grains and oilseeds and all things of that nature. He's can be followed at Wheat Watcher, and myself, you can follow me at meat_watcher on Twitter. Andrew and I also run a hobby podcast that we talk about markets, that we get interesting people on to chat with about things that are affecting agricultural markets. And by all means, if you like listening to podcasts, have a search for the Ag Watchers. We have a @AgWatchers account on Twitter, but we also have podcasts available for download. I think we're up to about 170 something. So they're fairly regular. But any service that you download podcasts from, you should be able to locate us and have a listen if that's your interest. We're pretty much coming right up to Q2, Peter. So with that, I think I'll sign off. You can jump back and we can run through some questions if you like.
Thanks, Matt. That very insightful as always, Matt. So guys, you should see my screen in a second. We've already had a few questions come in, especially about that report, Matt. So just bear with me, guys, as I share. So what I'm going to put up when my computer wakes up will be some links. Now, as you know, we meet fortnightly for these webinars. Our next webinar will be with Dr. Colin Trengrove again. So we had a lot of interest there in supplements and mineral deficiencies for ewes. He's going to cover off lambs in our next webinar. So bear with me, guys, just having a little technical issue. Shouldn't be too far away. Matt, we haven't had any other questions come in other than, given processor margins and low utilisation of processor plants, beef processor plants, do you guys expect any processors to be exiting or closing out due to this pressure?
Yeah, that's a great question. I think you said the globalisation of processors as well, wasn't it, at the start there, was what you're referring to?
No, given processor margins. and low utilisation of
Yep.
plant. So I think that refers to
right, yeah, no, for sure. So that's actually a great question, and I probably could have included the chart that shows, because the report I referenced, which was that AMPC report, was about a 6-pager that's available on the AMPC website, and that actually showed, there was a chart on that particular report that showed periods in time during that 2008 to 2018 years when processor margins, according to the model, went into negative or significant negative, that they kind of married those times up with processor closures. And there's a fairly strong relationship between times of negative margin or extended times of negative margin for processors and closure or rationalisation of the market. And we have seen some of it last season. There was an abattoir in Victoria, northern Victoria, that was taken over by an offshore player, a family-run abattoir, and then we've also seen a big operator, Minerva from Brazil, have taken over a couple of abattoirs in WA last year. So those, and I think if you look beyond the beef abattoir space exclusively, we've seen the likes of JBS, who's obviously very, very present in Australia, but they're massive global meatworks, and they've come in and looked to extend their kind of holdings of processing of the pig sector just last year in Victoria. So you know, times when times when I guess Australia, we've seen the processor margins quite negative in Australia. The curious thing is when we look to see what's happening currently in the US, they're in their 3rd year of cattle liquidation, and they're having a significant drought over there, and that's fairly common when we get a really wet season because of La Nina in Australia, and we can be pushed into herd rebuild. Often in North America, they go into a drought situation in a La Nina episode. And so the US have been suffering through that, and that's meant that quite high turnoff and lower prices for cattle that would be normally expected. And that's actually meant that North American processors are actually making record margins presently. And so for a company like a JBS that's got a footprint in North America and also in Australia, from that perspective, some of the losses that they're seeing or the tighter margins that they might be seeing here are being offset on a global basis by really strong margins somewhere else. And that points to that strength of diversity across different market segments. So yeah, I think with what's been happening in the processor sector, I think there's a real risk into this year that we continue to see continued consolidation of the Australian processor sector, and some of those maybe smaller, independent, less abattoirs that have either not multi-species, so they're stuck with maybe one species type, and if it is beef, then it's tough times for them, and if they don't have the economies of scale with which to operate more efficiently than say some of the bigger players, and they're maybe not regionally diverse across the country, so they can have a bit of diversification efficiencies there, then you could see some of those smaller players being gobbled up by some of the bigger guys. And from a market competitive perspective, I'd kind of be concerned if we saw too much consolidation in that space. Like anything, when you've got lots of buyers and sellers in a market, it tends to make a market that operates much more efficiently. And when you've got players within a market that have too much market power, that tends to cause problems for some of the participants that don't have as much bargaining power.
Great, thanks, Matt. That very detailed and very thorough answer. And you factored in more than the question. There's a lot in that question. So, guys, I've now got up on screen further information. So this, as we said, this webinar is recorded, and you can see where it will be accessible in about 2 to 3 days. You can't see the links, but again, they'll be available next to that webinar. So MLA market reports, MLA market analysis and industry projections. If you Google either of those, they'll come up. So a fair few more questions here, Matt. So we'll keep trucking. A specific question on Wagyu, but why don't we? We'll consider it for Wagyu, but also other breeds. Can you pull Wagyu information from the MLA data, both for full blood or F1?
Yeah, good question. Again, no, you can't for Wagyu, but you can get, so Auctions Plus that people would be familiar with also have a new or a relatively new data platform, and it's fairly cheap to access. So that's called Livestock BI, and you can log on to that, and for a fairly low cost, you can access Wagyu-based data that are going through that Auctions Plus platform. It's not the entire Wagyu market, because quite a lot of that market goes direct, of course. But in the absence of any other pricing data, that is a really good source to get Wagyu information in terms of pricing. We do put out on Thomas Elder Markets. I think the last time I did it was August 2021. I updated what was happening. I'm probably due for another update to put out another Wagyu piece. So that probably prompts me to do that in the next week or so, where I can actually go and pull the relevant data out and do the work for you. So that's probably a good plug to say for those that are subscribers to our service, and for producers that some of our best analysis we put on the website are actually requests from producers that say, oh, I'd like to look at X. And we're more than happy to do that stuff. Obviously, if we're doing it and it's on the website for everyone to see, then there's no fee charged for that. We just do it as a service, and because we get such good requests like that, it helps our service be relevant to the subscribers. So we don't mind doing it when we can. Obviously, sometimes we have, the client work that pays us takes precedence. So sometimes we schedule it in for a week or two or a month later, but generally we try our best to get around to those types of requests. So I would encourage, if people are on the website, don't be scared to drop us an email or give us a phone call or something, and say, hey, have you guys thought about looking at this? Because sometimes they're the best things we look at when we get those types of suggestions.
Great. This is putting you in the hot seat a bit here, Matt, so you can decline this question if you want. Empty females in the paddock, would you fatten them or join them to sell PTIC? I guess the other option could be you could sell them as is. What's your crystal ball suggesting is the best option?
I think if you're looking at joining them now, depending upon at what stage, I guess, yeah. I mean, yeah, if you join them now, you could probably still do okay. I do think that, I mean, it is a tricky one because, like I said, the modelling, I haven't got a particular fair value model for cows and for PTIC cows as well, because I haven't got around to building one yet, is the honest answer, because it does take some time to build them. But, given that both of those models are showing some level of softening prices, I do think we're probably not likely to see it in the early part of this year, like the first half of this year, but I do think towards the back end of 2022, we might see some slight softening of price, of circa 5 to maybe 8 to 8%, say, from current levels. I think the bigger declines will probably start to flow through. When I say bigger, maybe 10 to 15% price declines into 2023, and again probably into the middle of the year. So if you are kind of looking to do PTIC and sell as either PTIC already or perhaps with a calf at foot already, you might be starting to catch some of that downturn. It's a bit of a hard one because it could come, the end of this year could come into mid to early 2023. It might extend out to 2023, and you might get through and make some good money from it. But given that I think there's more headwinds than not, unless you're ready to go reasonably quickly to get a bull over those cattle or those cows, I'd be possibly inclined to just consider sticking with the empties and look to just add the weight and maybe sell them, because you've probably got a bit more flexibility there in that space. I think, does that answer your question?
I think that's a great answer, mate. That'll cover it off. Now, some pretty detailed responses needed for these last two, so we might shorten them up if possible, Matt. Domestic beef consumption tracking with high. How is domestic beef consumption tracking with the higher retail price? And currently, what is the domestic market as a percentage of total production?
Yep, that's a reasonably easy one. We have seen domestic consumption declining over the last few years, which is something we're seeing across quite a lot of the Western world in terms of consumer behaviour, that people are having, and it is. I think it is partially a value thing, and it's also partially a health thing, and partially I think there's a range of factors. But within Australia, I think we're sitting now at about 20 kilos of beef per person per annum is the current figure. If you go back to a decade or so ago, it was up around 35 kilos. So we have seen that declining. Multiple reasons for, and yeah. So I can't now. What was the second? There was a second part of that question you asked me as well. That
domestic versus
my mind.
Other.
Domestic versus
export.
Yeah, correct. So in perspective, on any given year, the export volumes are about somewhere between 70 to 75% of our production is exported, and so the domestic consumption on a percentage basis is around, we consume about 25%, or maybe as high as the high 20s, or as was what we consume domestically on any given year. So the bulk of our production into overseas.
Okay, and two more questions. Could US processor margins be accounting for their growing market share in China, or is it mainly the Trump deal?
I don't know. I think look, historically, like that chart showed that China was not really on the radar of the US. There were China had issues around the lower level of traceability of cattle in the US. They also had issues with some of the additives used in the US feedlots. So there were kind of non-price related issues as to why the US hadn't really been able to penetrate into China up until that trade deal. But part of that 2020 deal was that some of those requirements on US cattle were kind of eased, and that allowed for those animals to kind of make their way in. Probably also we should make the note that it coincided with a time when China was desperate for protein of any kind, and beef was one as well. That I think there was the beginnings of those political tensions between China and Australia, that the Chinese authorities I think could see that the US beef was maybe a good substitution for the Australian beef, and they could potentially, this is speculation of course, that they could potentially have an alternative source for that high quality type beef that Australia and the US are both renowned for in terms of that grain-fed type beef product. And so I think it was a fortuitous timing for Trump to put that deal in, and they managed to kind of create a bit of a wedge with which to, or a stick with which to bash the Australians with a little bit at the same time.
No worries. Now, last question. I can help you out here. How many plates per head per week for domestic beef consumption on a 20 kilo annual consumption per Australian person? Is that what you said?
Yeah, that's right. I think it's 20 or 22 if I'm precise. Yeah, it's down in the low 20s for sure.
385 grams per week per person. So depending on how...
It's not a lot, is it? But it's not a lot, but I guess there's a lot of people that eat chicken and pork or God forbid, no meat at all.
Yeah, so for maybe a person like myself, that's not even one plate, and for other people it might be two. So that closes out all the questions. Thanks, Matt.
No problems. I think I just put on the questions area there, I did put a link to that AMPC report. I'm not sure if anyone can pull that down and see that. Or maybe it was on the chat. I put it in the chat room there. So if anyone wants to try and have a look at that AMPC report themselves, the link's there to go and jump into it.
Bear with me, and I'll just put it up there for everyone to see. And hopefully everyone can see that now in the chat space. All right, Matt. So thanks again for some really informative insights into, what the market's doing and where potentially we're heading. And thank you all for sticking around. As I said before, we value your feedback. Please complete the survey, and thanks for tuning in. Night, everyone.